Greetings, market rebels. Welcome to this week's macro measure. It is Sunday, April 14th, 2024, about 9:15 a.m. on the East Coast. I'm going to flash our usual starter slides and we will get into things. Here's our trusty disclaimer. Here is our intellectual property rights notice. And then here is this week's notes. A lot of revisions because we finally got something that we were thinking could happen, I guess would be one way to put it, in April, especially due to the cycles and where we were and the rest of it. But I'll leave those notes up there and then we'll make our switch. I will also flash quickly just last week's notes. And we got started, I think, on some of these concerns in the start of March, just in case they caught us off guard with by starting to let the market drop sooner rather than later. But we worked our way into April and we did get the start maybe of something that could be concerning. So we'll see. So let me just reposition things. I'm going to stop the share briefly and move my notes over somewhere else. And then I'm going to pick it up just with, let's see, I think the best thing to do right now would just be to pick up I've got a browser window that I like to go through quickly, and then we'll just get into the charts and the overall discussion. Let's see if I can get this to show properly. Hopefully screen 4 will come up. Share. And there we go. And it does look like it's working. So I'm going to max it out. But I mean, I think we've been talking about this, for months and months, about really the second year in a row where we were not so sure that we were buying the story about rates lower for a few different reasons. Not worth really recapitulating those right now, but that's really been undercut. You've got this 94% chance that in a few weeks when the Fed meets, we stay still. The June meeting, it's about 5.5, 6 weeks later. There's a 71, nearly 72% chance that we sit tight there. And even in July, I think it's kind of split at this point, where they were already, of course, factoring in rate cuts. So you have to really go out. This is kind of 50-50-ish, but you do have this big drop expected. I'm not sure what's going on there. Maybe they are expecting some sort of issue to develop that would bring rates down sooner, would be one way to put it. But definitely they think at this point, right, that we're down by SEP. So that's the look at that. We finally got the rollover. I think in fear and greed, we were really just stuck mainly in greed for a long time. It didn't really get super extreme. It did get a little bit extreme at times, but it was just there for a long time. And I think with the kind of performance that we saw and so on and so forth, you sort of sense with the market, as we were discussing it leading up to last week, the market was losing some of its vigor. You had to give the bulls credit. They hadn't let anything crack. They really still haven't completely either. So, but it certainly could have been something where in retrospect, if they had somehow managed to pull off yet another leg of a rally, you'd be really impressed because they gave so little back of the ramp that started in October at the lows. But now it looks like we did finally get a little bit more. And sentiment did drop off coming into the middle of last week. So we were getting down there a little bit. Maybe the lack of advance was starting to weigh on people, and they realized that we're probably due for some more of a pullback. Anyway, I'm just going to keep it minimized today, but these are just some of the things that we try to cover, but don't always get to it. And everyone prefers that these videos are much shorter, but I think it's time to mention these again, that you've got things like this happening that the party has ignored. The stock market party of 2024 has ignored. So again, we think, I think the credit card debt levels are at extremes. The delinquencies are starting to become extreme. The rates they're paying, the balances carried are extreme. Jamie Dimon came out with cracks in subprime auto, right? So there's issues there. We've been talking about that really being a potential source of trouble because of how expensive autos became and just how insane the financing has become with some people buying vehicles and really having a mortgage payment in terms of the level monthly cost but on an automobile, that depreciating type asset. Anyway, this is also another thing worth noting: the commercial real estate issue. Just that's not going away. So just wanted to cover those basic things because it all tends to get lost, but there's a lot. This is what we've really been saying. There's a lot under the surface that's been brewing and then it's very common for the market to ignore all that while there's easy financial conditions and the trend is up. And that's what we've had, very easy financial conditions relative to the last few years. I think you're back in 2021 ease levels. And yeah, that's it. I mean, you've got that and you've got the momentum, and the market's always full of true believers. So looking past this, that, and the other thing. So, and they may be right to, we have to acknowledge that they may be right to. We don't know exactly what's going to happen. And I would say that the bull argument could come back all over again because let me see if I can pull that over real quick. And I think that's one of our notes. I'll bring these up to kind of conclude things, but right here, well, actually that's last week. Here's this week. I even think I put a note in on that one that um, they could be having you could end up with a situation where they'll we do get more of a market smash here. The bulls will just come right back with it. Well, this justifies rates lower sooner too. And that's just the nature of what they do and how they think and what they clamor for. And that, I would say that has a shot of being true if there's really something really dramatic were to happen. I mean, the Iran-Israel thing we have to mention. Hate to see these types of things break out, but that's obviously something that could lead to something. And obviously, it's probably been affecting the risk of that's probably been affecting the way some of the things have behaved in the market. But I'm starting out with the SPYs. We usually start out as that our proxy. And if you want to know why we don't just chart the index, it's just so, but with the levels we talk about, people like to use for their trading. So we just stick with the SPY. But we said for, I think, a while, the last couple of weeks, if the 20 gave way, we have to look at the 50. And what we always prefer to do, if we can, is kind of find where there's confluence of different forms of support if we're looking at things on the way down or not naturally resistance on the way up. And you can see there's definitely a flat line right near the 50. So if you ask me, with all this sort of activity that went on around it, you can see that we've been pointing this out in webinars during the week that we did lose momentum. It was becoming obvious. Breadth started to roll over a little bit, but it hung in there for the most part. But of course, this week was when breadth really took the beating. I guess I could flash that really quickly. I think that chart's right here, and I'll try to just maximize this a little bit. And there you go. But you can see that these are just some basic breadth measures that I keep on this particular screen or layout. And I have other things I like to look at that are on different websites that I subscribe to and things like that. But this is just basic stuff on Thinkorswim, and I've got a couple other layouts, but I like to just go to this one because it has a bunch of things we could look at. And when you I like the whole composite thing where you see a lot of things suggesting the same type of thing, and everything really, McClellan oscillator really with lower highs making new lows, it's almost getting to the point where you have to think that it could be overdone. But McClellan summation, that's the longer sort of longer term oriented, takes a while to move. That also has broken support, and that's making a new recent low. And it could have a long way to go if we're going to see more of a correction, more significant correction. But getting back to the SPY, what I've done, I thought I had it on here. Maybe I took it away. I'll make sure I add this while we discuss it. But I'm just going to put some support and resistance lines on here, mainly resistance lines, because the support I'd rather just talk about and not try to. There's one right there. And that really becomes the 20-day. If you look at that light blue line right there, you really have to get back above your 20-day at the least to feel like, okay, I'm taking out resistance and now this could really go. So uh, this low here is a big deal, right? We think there's a flat line. We also think that there's the 50 day, and that's very widely followed. And there's a gap here that could end up mattering. And that gap comes in at the 23.6% retracement level on the fib that I put on here to make this clear as to where we may retrace to if you follow such things. So once again, I prefer to have various forms of support all come in near a fib and different reasons. And at least here, I think there's this sort of a little bit of support just in general from trading around there, but you've got the gap and you've got that round number factor of near 500, and usually they go a little bit overboard. So 497-ish would make a lot of sense in that regard, and it would still be a bullish pullback because you would only be retracing 23.6% of the entire near relentless move higher that we've seen really for, well, I guess it's 6 months since we saw, but we've started rolling over recently. But we had about a 5.5 months of generally bullish fun until the last couple of weeks. But yeah, you can see this took it on the chin. There's a couple reasons why we think there'd be support near 500, the round number effect, the gap fill, the Fibonacci, and a little bit of dancing around that the ETF did at that level, which is actually very common. It'll be just easier way to put it, near a big number. So you've got that. Where does the 100 work in? Well, if we kind of we go through a slow slog lower, the 100 might even get in that ballpark, right? Because a lot of these older lower prices will be dropping off and to be replaced by newer higher prices. So that could accelerate up. I mean, it wouldn't take very long. It might only take a week to work its way back up to about there, maybe a little bit longer. Depends on what prices come off. I don't even want to go into that nitty gritty, but it's very clear just looking at some basic indicators down here, oscillators, that the momentum has been, taken out of this market. You can see the rollover of the RSI very clearly on that line. The other indicators there as well, just simple stuff, but you could tell that was happening. That's why I try to be objective and just note that. And you could see that happening, that the market was losing it. Now, as long as it doesn't crack support, I consider it a big win for bulls. If you can have the kind of ramp job that they had for 5.5 months and hold on to over, near 90% of your gains when you're actually backing off the overboughtness and then getting set up for maybe EPS season or rate reductions or both, that would be great. But the rate reductions, unless things really probably get smashed, they're probably not happening, or other developments would need to happen. So it just all depends now on what's going on geopolitically and how, if that elevates or it just sort of, that's it, right? We don't see elevation out of it. But other things, of course, could begin to elevate in terms of creating chaos and other things like that. So there's the kind of quick take on the SPYs. If you think there's going to be more downside, I can understand why. I think there should be a little more downside. I've been saying we should see a pullback. It does make sense to me that this would happen sooner rather than later. But remember, there's no one better than the gang. That's why they're the gang. And so if they do allow this to roll over more, just remember that if this right near where we close, there's also support near this 510, 511 in the SPY. It wouldn't be right. We could definitely drop a line there. In fact, I guess I will. I'll just put a flat line on there, just in that ballpark for us, just to make the case. But let's see, I think right around close is close enough for now. So it wouldn't be something, right, that would be crazy the way that these guys operate to get maybe a whoosh effect, that you have a really couple of rough sessions or maybe one really rough session, and then they bounce this thing back up to former support. That's what you've got to watch out for. That's one of my be careful reminders for the week, because even if you do get this, I'm not saying that it can't just keep cratering lower. I'm just saying that it's very common for these guys to have a serious break and then work things back up to the support that gave way, to test it from the underside to possibly convert it to resistance. So just keep that in mind. Again, that's why you have to roll. And that's why some trades, right, if you start seeing them after you've maybe gotten a good score, if there is a sell-off, you get a good score, then what you need to do, in my opinion, is you roll aggressively, take a lot of those profits. If they start really eating away of your into your rolled contracts and they're starting to hurt you, remember, you can always exit and then start a whole fresh trade. There's nothing wrong with that. It just depends on the conditions and what's going on when you're near that support level. If you wait that long and if they're turning it or whatever, keep your eye on all the Fed speakers that are up to their tricks this week. You've got the earnings that'll be hitting fast and furious, starting sooner rather than later. So there's a lot happening. And of course, the geopolitical and the other Jamie Dimon, JPM-esque financial system concerns. It's no wonder, right, that a lot of things like the dollar, rates, gold, silver, oil, right, that a lot of these things had the week that they did, given what's going on out there in total. So again, probably my spot would be right near the 500 level. That's only about 2% at this point. If you do get worse than that, then you start thinking about the 100, I think, at 490. And then you've got to start thinking about the 38.2 retracement. And I don't really see much else there near the 38.2. So I would probably lean more towards this white line. Not that I wouldn't, if I waited for a while and I got really within $2 on a $500 index, I would certainly be making some adjustments, right, in terms of profit taking and risk reduction and what have you. Still sticking with it if the pressure's there, if the momentum's there. But, right, I think there's definitely a flat line that's just a little below there. So this is a little zone, I think, from about 478, excuse me, to about 480-ish that I would think would be another area where they might come in at if we do fall that far. Excuse me. So if somehow they get ServPro to come in and like it never happened and they start working things back up, I think the most aggressive area is going to be that at this point, it's about 518-ish, 519. So you could start saying, well, they're breaking this thing back out again. And they very well could. I don't expect that, but I've learned to keep my mind open in the market about what can happen, because sometimes in the face of all things sane, these guys will pull off some moves that are just remarkable, right? Just think about all the problems that have been developing. And you were really on, I guess, Tuesday of last week, you were within a stone's throw, right? Less than 0.5% from the all-time high. So if you want to know, right, what they're capable of, that's what they're capable of. I think even on Thursday, right, they were not very far away. The high there, you're like 1%. I think you're 1% away from the all-time high. And I think you could just see problems developing, but it didn't matter, right? Because if they get people off poorly footed, off a balance, and they're too short. And remember, we talked about how they did play games throughout the week with, up, down, made it very hard on people to remain sustained bears, unless you really just were committed to it and said, look, unless they make a new all-time high, I'm not getting out of my position, period. Right? Unless they have a new closing high, whatever the case may be. But yeah, so you could have done that, but they would have put you through the ringer if you were watching the action closely, right? Up, down, the same old gang doing the same old gang tricks. But that's why patience is so is such a when you're in trading, and being patient is just as important as being decisive. It's just at times, right? That's why it's not an easy game. You have to really go from extreme to extreme sometimes, and it's never if you're doing it, discretionary, and you're not systematic about what you're doing, it can be really tough to make that call, at all times, especially breakdowns that everyone knows ought to be coming, and where there's evidence for deterioration and things like that. But we also should note, so there's kind of the overall take on SPY. We should note, though, that things are in a little different position in all the different of the four major indices that we cover in macro measure. So let's flash a couple things that we talked about just for the record. Everyone probably knows this already, but it's not common, right, for the VIX to really stick its neck out on a Friday. It's kind of been the big talk about, has the VIX lost its way? It did back off a lot from the highs, but that's a strong close on a Friday for the VIX. So, and remember, there's a couple of, we think that 50 Cent, the famous VIX trader that buys the out of the money calls, we believe that that player is long, I think, the 35s in May, and I think it's May and June, like 150,000 contracts a piece. So just keep that in mind, that 50 Cent is lurking out there, having bought stuff about 3 weeks ago to a month ago. The dollar, this sort of risk off flight to quality. There's the dollar powering up, right? This is typically not good for stocks. You had, oh, I forgot, they changed the symbol. Let me see if I can get TNX CGI. This is the yield. So 10-year yield. I'm not sure the story behind this, but backed off a little from popping, but you can still see the trend. You can still see that it's moving higher, right? So again, we mentioned this last week. It's been at odds with, really been at odds with the the market, right? Where rates in the market were pretty inversely correlated. Markets had a really good year. Rates have moved up a lot since the bottom in December, as you can see there, and it hasn't bothered the market to this point really in a big way, but I guess maybe it's starting to, or at least it did. We'll see if there's follow through. Oil had a heck of a run. So, and now we had this kind of reversal candle there on Friday, but it was at one point on Friday right near the highest recent highs. So whatever that's worth, but I just want to make the point that a lot of these commodities and have really, really ramped. Copper, I think, had a similar performance to oil. It finished the week, finished a little bit better, but did back off the high. That's what I was getting at. So that was up. Let's see. Gold was also very strong, and so this is sort of more of a, I guess, sector situation discussion. But I just find these things very hard to separate, because I just think it's really like looking at just how the market behaves, and I think just charting in a vacuum to me, it's just not the way to go. When it comes to the macro picture, but I think you're better served by going a little bit deeper and looking at a lot of things are acting just the same way I like to do the composite charting. But that's just my thinking on it and what makes me feel comfortable. But just remember that we talked about this back in the fall, that there was a cup and handle developing in gold and silver, and it was on a very big picture chart like the monthly. And if this thing does fire, and we said, that these are typically good patterns, if it fires, it has a lot of promise. So I don't want to get everybody overhyped or anything, but it's been firing, right? It's been working. And we changed our tune on it in terms of leaving it for dead as a trading vehicle about 2 months ago, or 6 weeks to 2 months ago, something like that. So I don't want to belabor that, but you can see that all those things are really, they've been heading up. So that's worth noting. Now, the breadth measures we checked out. Let's check out the sectors. And I think the sectors, I'll go into this on sector situation, but you can see, right, that just I'll try to enlarge these a little bit just so hopefully, because I know that we've got a lot on here, but I think I just want to make the point that this became risk off, right? That virtually everything either became pressured or cracked after becoming pressured. So even former leaders like XLF, it's no surprise with what JPM had to say. Discretionary finished near the lows, right? Consumer discretionary. I'll go into this on sector situation, not really macro measure material, but I just wanted to make it clear, right, that virtually everything rolled over or is on the verge of cracking. The only things that are left really are the Mag 7 and things like XLK, right? So the technology sector, which we'll use as a lead into QQQ. But this is really where their leaders are, and they did marshal some forces and they moved Apple up significantly right off of those recent lows. That was a story of the week as well. And so it is what it is, but this is yet to crack. So this is not anything that surprises me, frankly, because in my experience, the last thing that they really want to start hitting is the big dog tech that they all own, because those weights will just weigh on the market and then selling begets selling. So I do think that quite often they like to avoid selling some of their favorites, right? Their bigger holdings. And so this is not a surprise, but if this cracks, this will be the last thing. I think your XLK, your SMH, that's really the last holdout. XLC a little bit too, but almost everything else is already correcting. This really still is holding on, but you've got the white ovals are gaps that were left on the way up. You've got a Fibonacci on here, right? So even if you get a very bullish retracement of only 23.6, the 100 would probably come in just about at that 424 level. You could see that we traded near that 424 level. And there's a gap closure near that 424 level. So to me, right, this suggests to me that there's another 2 to 2.5 to 3% of downside here if this cracks. But what would you use for a crack? That's the issue here. The 50 is the obvious one we pointed to with where this would get to or where it would need to crack. But you can see that right below there's a little bit of flatline type support where we saw it act as support and resistance. So that's right near really this low from 4.4, which is 435-ish. So again, trying to get it down to the pennies tough because we've even seen 433 act as support right on extremes in terms of the wicks of some of these candles. But that's the thing right there. I think you're looking at, right, you may as well use this low, 435, if we do see the market come under pressure this week. Now, what about the upside? What did it just move? I don't know what I moved. I didn't mean to. Anyway, I think you can see, right? It's the way that this is unfolding. It's really, you've got to really make it through probably Thursday's high of 446. So you've got to go up a couple percent, and then you start feeling, I think, a little bit better that, hey, it's sort of weathered the storm. But we need more information. We need more price action to develop to really put a more aggressive level on that. I think I don't feel so good about just putting a resistance line in here. I think I would wait it out. Now, if you want to be super aggressive, you can. That's really super, super aggressive, though. And I just keep overdoing it a little bit, and it keeps hiding but this would be what I'm referring to. So if you want to be a super aggressive bull, and I have nothing wrong with that, as long as you're a good risk manager, and you're disciplined, there you go. Right. So that would be it. You get back above Friday's high, you could start going long. Remember, you'd be above all the SMAs at that point if that matters to you. But those are the levels to me. I think you're really looking at about 440, let's call it 447 to be safe, which is almost like saying making a new all-time high. And the low of Thursday, I think, is where you could say this is starting to get serious if it happens. And it probably should happen, but these guys are amazing, right? They're capable of they're really capable of taking something that really looks bad, sounds bad on a Friday, and forgetting all about it by Monday morning. Remember, if they have enough shorts that they can impale, they will. That's what's been happening so much of the time, right? In this bullish phase we've been in now since, well, for nearly 6 months. So the diamonds got a little ahead of this SPY and certainly QQQ. They already fell to the 100. They already fell to the 23.6 retracement. And I think for them, right, I've got these aggressively drawn lines so you can see that. Again, that would really be Friday's high. If you want to wait a little bit longer to get through probably a more stout and important resistance line, it's probably going to be probably Thursday's low, right? So there's your two numbers if you're trying to catch sort of like a bounce trade that could develop. And just I'll reiterate it again. Remember, a lot of times what they'll do is break down, break through, find support at a very let's say obvious area where you would expect there to be some support, like a 100-day, and then put a bounce together to test from the underside what was formerly support, and that would maybe be your 50 SMA. There's a flat line near the 50 right now. That's at about 388. That's again about 2% ish above here. And if it gets through there, right, you still really aren't out of the woods. You still have to be careful because you've got your SMAs rolling over, and the shorties, that is, there some of them are about to roll below a little bit longer term, like the 50. But that would be, as long as they're above there, I think the immediate pressure would be off. If they start falling back below again quickly, well, that was just a squeeze, right? And you're maybe resuming what you were already in, and they just pulled off yet another squeeze. So again, that's what makes it really tough, and that's why we're big on telling folks to roll. And then if that final roll isn't working out, just dump it and then get ready potentially to either trade the bounce, or if you're just really bearish, just wait for another opportunity. And that could come the same day, right? If that rally attempt fails when you're in a volatile market. So there's nothing wrong with that. And with the way that commissions and fees and all are these days, it's pretty reasonable, right, to be able to do pretty much whatever you want and not get eaten alive by commissions the way former eras did, traders in former eras, I should say. But anyway, right, where would you look for continuation to the downside? I think in the diamonds, you're looking at the low on Friday, right? I think you could see probably there's going to be support at about 377.58. So you're not too far from support. So if you did trade a further breakdown, just be careful. They're going to have a couple of different flat lines in there. You've got 377, you've got 375. You can see a lot of this price between the opens, closes, highs, lows. You've got 373. All these levels sort of this was a congestion zone back here, so it's not a surprise that there's a lot of potential support in there. 372, right? So there's a lot of support coming in the next 1 to 2% down. And you even get at the very bottom of that is your 38.2%, right? And that's just a little bit down there at just below 370. So again, you're looking at about two more percent at that point. After that, it's probably a little dicey because you could believe in the 150 that's rust colored there, or maybe not. And if you don't, you probably believe more in the 200, and that's fine. And that's definitely down another couple of percent, and you get an even larger correction. The gaps, we have gaps that I thought I put a line there. I must have flubbed that up somehow. But if this gets really ugly for whatever reason, when you've got geopolitical and things like that, you have a problem. And again, I think that would be something that maybe would help the Fed turn on a dime more, would be if the market gets routed due to geopolitical, then or geopolitical plus, let's put it that way, then they'll maybe be quicker to act, and they'll start pricing in cuts, and they'll all be happy. So that's that. I think really, again, where to get bullish on there. I think getting bullish on there is, I already mentioned those are very aggressive bullish levels, not something that I would stick around for too long, if given what the trend is and given how dire things look. And we have to wait and see how things open. But could be some rough sledding. We'll see. Let's take a look at IWM. And this one, interestingly, I don't think this has gotten as clobbered as the diamonds, but it has started to get hit. You can see that it lost the 50 there later in the week. In gold, it got below the 23.6% retracement. We have the 100 coming in right here. And I think if you look back between the 100 at about 197.50-ish, and if I just keep my cursor near there, you can see that they're right around that level. There's been some activity in terms of, opens, closes, wicks, what have you. So there is a little bit of regular, good old standard support that would appear over here. And I think the more important level to me, though, is this 193 level. So I think that's where there's more sort of classic support in terms of the stock was respecting that level and as support, as resistance in prior action that's relatively recent. So that that level to me tends to matter. If I extended the line over, I think you'd see that it actually carries over and matters further in the past, but there's no need to go into all that. But if that doesn't hold out, then you start and there's also the 38.2 retracement is near 193. If that doesn't hold out, though, then you're getting into the 200, 150 area near 190. Your next retracement's at 186.77 will put you at the 50%. So I would say, look, there's a zone of support between the 200 and the 186 retracement level, roughly speaking, 186.77. So that's where I'd be looking for that if it does intensify. If you wanted to get back in and say, I'm expecting a bounce, you could try to use, I think, the 50-day right now, right, to feel better about it. Now, naturally, if you wanted to drop down to intraday charts, you can become much more aggressive. But if you're someone that likes the, let's say, reliability factor of the daily chart, then you probably want to stick with some of these numbers if you like them. But I still think, right, you'd be in a congestion zone. That resistance line I just drew in there really dovetails with the former support line that we cracked last week. So that to me is going to be right around 204, and there happens to be a line at 204, right, as well, that I put there. I don't know why I have an alert on that or whatnot, but I guess I noticed that was an important level, maybe in the past, I guess. Anyway, the 204 level, that's the big one in terms of if this thing could rescue itself. And like I said, I would expect there to be volatility. I would expect that we're finally like moving away from that kind of boring phase that we've been in that's been kind of kept some movement bottled up. But hopefully covering these levels will help folks out this week. But I do think you just got to stick with your discipline because you know how quickly things started to sell off and how quickly things started to ramp, right? They started to smash things pretty quickly on Friday, but on Thursday, once you got into, I think, the close of Europe, a little after that, or maybe it was little after lunch, they really started to jam things. So that we know that these guys are great at doing this stuff. So moving it around in either direction. So get ready. I would be ready to trade the downside. Remember, if things get really ugly, it could take several sessions. It could take several weeks. It may never happen. But if things get really ugly, that's possibly going to sway the whole interest rate situation all over again. That'll give the Fed the cover that the bulls will demand that they start lowering rates. And because, hey, we've had this really major problems around the world, or we've got problems here, you need to lower rates and make sure the economy doesn't suffer too much. I think it'll start up all over again, the talk at least, and it could be enough to produce a nice squeeze at some point at the very least. So that's the look on everything macro-wise with the four biggies that we cover. I don't really want to belabor it. I do think that you've got to be prepared for everything in terms of Fed speakers, right? You've got crypto developments that are coming up soon. You've got the precious metal talk where a lot of upgrades are happening, and there's apparently a lot of central banks are, I guess, intensifying their purchasing of the metals. Clearly, right, Iran-Israel situation. Inflation, as I noted, undead. Again, just have to stick with that. That's on ropes. The story, I think, has effectively been shattered for the second year in a row. But like I said, it could come back in a different way if they get a real beating in the market. That would probably give them uh, some kind of cover to move back into that mode, or at least argue that way. So we've been saying we were in the latter innings. It definitely feels that way. There's no victory lap, though. Like, we shouldn't be taking a victory lap. You just never know what will happen. It's not about really any prediction or so on and so forth. It's really about, you just take a look at the conditions, you look at things objectively, you stick with the trend as long as you can, knowing how these types of trends operate, knowing how there's differences between uptrends and downtrends and corrective activity versus strongly trending activity, and so on and so forth. But I'm just mentioning it because we did think we were in the latter innings. A lot of it made a lot of sense. It's a little scary when things make sense and they kind of happen around the timeline you were thinking it should, sometime in April, maybe into May. But again, it's more about let's do the best we can than it is about being happy about, the market's rolling over like so many things suggested it was, or indicated it was likely to do. Right? Let's just keep our eye on the ball. I did remind everybody about the old breakdown, then bounce to former support trick. Remember, though, they could have that up their sleeve at some point. They may be doing some spring cleaning here, right, to set up for, in other words, let things come off. They deserve to come off. They should come off. Let's let them come off. And then when things are at a lower level, we can use EPS to start moving them back up. But is that going to be possible with world and domestic realities the way they are? That's the next part of our question. I did mention the market smash could bring, the lower rates, lower sooner story back. Remember, financial conditions remain favorable, easy. So that the last I've seen on that is that's where you are. I still think that the problems are there potentially in the banking system. Geopolitical, we've talked about, it's there. All these things that ramp we talked about and last week, and that's usually indicative of risk off. We did say that we thought maybe you'd see risk come back. I think risk definitely came back here. Just a question of what happens, okay, going forward. That's why if you want to know, like, why are these guys talking about butterflies, downside put butterflies? We wanted people to be prepared, right, in case that they wanted to use those as a hedge or even offensively. But that's why, right, I'd rather be early and at least mention that so you start thinking about it, rather than say, oh, now is the time, right, that you should put these on, when you already have a start of a potential swoon here. It's been a great market. We can't forget that. So, but I think the reminders to mentally prep, remain there. Like, you should really be open to both sides at this point. I think, if you're uncomfortable, try to get comfortable. We don't know what's going to come our way. So you could get more downside, and you don't want to miss out on that opportunity. And that's it. I think that's it. Just keep rolling, like we said during the video, right? You just got to be all over things when they get volatile, because there's inevitably, right, these guys find a way to move things back sort of bewilderingly at times. You're like, what is even triggering that? But it's just sort of the internal plumbing, and order flow and things like that drive it. So maybe too many people on one side of the boat. That old analogy always works as well. So on that note, I'm going to wrap things up. I'm going to thank everyone for tuning in. I do hope you got something out of this. I tried to keep it more about the charts than the overall discussion, just because I think we know where we are at this point. So it was a good departure from that. Everyone have a great conclusion of their weekend and a great and hopefully disciplined and profitable trading week ahead. Thanks again.